Welcome back to the Neuro Finance Masterclass. Look, I just want to take a quick second to, well, truly commend you. You have officially crushed the first 50 days of this financial transformation. And hey, that is no small feat. You've laid down the essential groundwork, you've mastered the basic math, and you've totally rewired your mindset. But today we step firmly into the advanced tier of Wall Street strategy. We're graduating from basic wealth accumulation and moving straight into the realm of wealth architecture. In this explainer, we're tackling the exact theme that separates the absolute best from the rest of the pack: asymmetric risk. Okay, let's dive into this syllabus. We're going to move systematically today, right from mathematical theory straight into concrete application. First up, we'll examine the dangerous illusion of the coin flip trap. Then we'll officially define asymmetric risk. Third, we'll look at how to actually cap your downside in the real-world stock market. Fourth, we'll apply the same logic to crypto using the satellite strategy. And finally, we'll leave you with a concrete action plan for auditing your own risk. Section 1. The coin flip trap. Stepping into the advanced tier. So let's start with a really foundational truth here. The world's greatest investors, the ones we like to call the architects, they absolutely despise fair bets. Seriously, if the odds are perfectly even, they simply won't play. They aren't looking for a level playing field, you know? They want a mathematical advantage. Think about it. If you offer an architect a simple coin flip where they risk $50 to make $50 or risk $100 to win $100, they're going to walk away without a second thought. That scenario is what we call symmetric risk. It's a basic 1-to-1 ratio. The amateur trap is looking at that and thinking, hey, that's a fair deal. But actually, if you play a symmetric game long enough, your wins and losses just cancel each other out. And when you factor in the time you spent, you are literally moving backward. It leads to zero progress. The architect, on the other hand, is completely obsessed with asymmetric risk, like risking just a single dollar to make 50. Section 2. Defining asymmetric risk, the holy grail of investing. Listen, to truly build a massive empire, to generate the kind of wealth that alters the trajectory of your family's future, you have got to stop flipping coins. You must seek out what is universally known among top-tier investors as the financial holy grail. Now, the absolutely crucial point here is nailing down the precise definition. Asymmetric risk is simply an investment where your downside, meaning the absolute maximum amount of capital you could possibly lose, is strictly capped. It has a hard floor. But the upside? Well, the potential profit is massively larger than the potential loss. Sometimes it's mathematically infinite. Let's break down the mechanics. You're looking for a scenario where you risk, say, just $1. If your entire thesis is totally wrong, you only lose that $1. Sure, it stings a little, but it doesn't destroy you. But if you're right, you make $10, $20, maybe $50. The risk and the reward are completely, gloriously unbalanced in your favor. Section 3. Capping the downside. Real-world stock market application. So understanding the theory is one thing, right? But how do we actually find this in the wild? How do we construct a portfolio that limits risk while leaving the ceiling wide open? Well, we use entirely conventional tools. We're talking about spotting a clearance sale stock. When you find a fundamentally strong dividend-paying company trading at a historically low price-to-earnings, or PE ratio, you are essentially buying into a massive clearance sale. And what's really interesting about this setup is how your downside is naturally protected by the real cash value and the physical assets of the business. You aren't buying hot air here. You're buying a cash-generating machine at a huge discount. The absolute worst thing that happens is you lose the cash you put in, but those strong fundamentals and dividends provide this incredibly powerful safety net that makes a total zero highly, highly unlikely. Let's map out the long-term timeline of a classic asymmetric stock play. Step 1. You invest your cash right during that historical clearance sale, usually when everyone else is panicking. Step 2. You sleep like a baby at night, relying on that real cash value to limit your downside. Step 3. You just wait. The market inevitably recovers and the company continues to innovate and adapt. And finally, Step 4. Over the next decade, the stock price actually multiplies. It doesn't just bump up 10%, no, it doubles, triples, or even quadruples. You risked a known limited amount of capital at a super low valuation, all for a massive multi-year upside. That right there, that is the architect at work. Section 4. The satellite strategy. The architect's approach to crypto. Now, an architect doesn't just apply this to blue-chip stocks. They take this exact same asymmetric risk framework and apply it to highly volatile markets too, specifically the cryptocurrency market. We like to call this the satellite strategy. And this brilliantly illustrates why we never ever put 100% of our wealth into something like Bitcoin. Notice how 95% of your core wealth is safely protected in highly stable cash-flowing assets. But taking just a tiny satellite position of 1 to 5% of your portfolio and putting it into crypto, well, that is the literal textbook's definition of asymmetric risk. Let's play out the absolute worst-case scenario. Say the entire crypto market collapses and goes straight to zero. What happens? You lose a tiny 5% of your wealth. It's just a little bump in the road. Your financial empire easily survives and just keeps right on growing. But look at the flip side of that exact same 5% bet. If Bitcoin actually achieves its thesis and becomes the global digital reserve asset, that tiny 5% allocation doesn't just grow by a few measly percentage points. It could multiply by 10x or even more. Think about that. A 10x return on a 5% position dramatically moves the needle on your total net worth. You have risked an almost negligible amount of your total capital for an upside that can permanently elevate your wealth tier. Massive upside, strictly capped downside. It is a beautiful thing.
Section 5. Auditing your risk. Today's action plan.
All right, this brings us to your main cognitive task for today. We are moving out of theory and straight into immediate, empowering action. Because frankly, you cannot build an empire if your foundation is filled with hidden symmetric traps. It is time to audit your risk. As you evaluate every single investment currently sitting in your portfolio, you must ruthlessly hunt down and eliminate what we call the amateur's game. So what does that look like? It looks like risking a catastrophic loss of your hard-earned capital just to squeeze out a tiny 4% or 5% gain. Honestly, it's like picking up pennies on a train track. Sure, you get the penny, but the downside is absolute destruction. If you have positions in your portfolio right now where your downside is essentially a bottomless pit, but your upside is capped at some modest little return, you are playing the wrong game. You need to identify those traps today. Your goal from day 51 onward is to only deploy capital when the math is fundamentally, almost unfairly, in your favor. Step fully into your role as a true architect of wealth and take this exact mindset into your audit today. I want you to look at every single asset you own and ask yourself this one ultimate diagnostic question. What is the absolute worst-case scenario here, and what is the best-case scenario? Find the asymmetry, flip the odds in your favor, and watch your empire grow. See you next time.